I was walking through Minato City in Tokyo the other day and noticed a small crowd gathered around a real estate agency window. There was a young woman there, probably in her late 20s, just staring at a listing for a standard two-bedroom flat. Her expression wasn't just one of shock, it was a look of total defeat. When I followed her gaze to the price tag, I saw why the numbers had surged 17% in a single year, hitting a record high that felt disconnected from reality. Nearby, an older man shook his head and muttered something about foreigners with cheap yen stealing the roof from over their heads. The woman nodded, her frustration finding an easy, visible target. It was a scene playing out across Japan, mirroring the fiery rhetoric of Prime Minister Sanae Takaichi's recent election campaign. To the people on the street, the villain is clear, the opportunistic outsider exploiting a weak currency. It's a narrative that makes for perfect politics because it provides someone to blame. But as I walked away from that window and looked toward the skyline, I noticed something that contradicted that simple story of greedy invaders. In a city known for constant renewal, the horizon felt strangely stagnant. If the market is supposedly being bought up, why has the supply of new apartments plummeted to its lowest level in over half a century? The truth, it turns out, is far less cinematic than a foreign invasion. While the public is busy pointing fingers at overseas investors, the real crisis is being driven by a quiet, mechanical breakdown, a desperate shortage of labor, and the skyrocketing cost of steel and timber. This same paradox is paralyzing cities from Seoul to Sydney. We are witnessing a double-edged sword where supply constraints are creating a goldmine for wealthy landlords and commercial investors while simultaneously locking an entire generation out of the dream of ownership. It raises a haunting question. In a region where too much money is chasing too few walls, what happens when the safety of real estate becomes a trap for the very economy it's supposed to support?
It creates a structural freeze, and frankly, that scene you witnessed in Minato is the perfect encapsulation of what we are seeing across the entire Asia-Pacific high-cost hub network.
You hit on the most important psychological element right at the start, the desire for a villain.
It's human nature, isn't it?
Yeah.
If I can't afford a house, I want a name and a face to be angry at. I want to point at the foreigner or the hedge fund manager and say, you did this.
It's clean. It gives you a target for that frustration. But the reality of what we are seeing in Tokyo, Sydney, Seoul, and even Singapore is that the villain isn't a person. It is a process. It's much more mechanical than that. Yeah. We are looking at a convergence of rigidities, labor, regulation, and raw material costs that have effectively poured concrete over the price floor. The prices cannot come down, not because of greed, but because the cost of bringing the product into existence has fundamentally shifted. Poured concrete over the price floor. That is a strong image. I want to dig into that because usually when we talk about inflation, we think of it as this temporary spike. You know, eggs get expensive because of bird flu, then the flocks recover, and eggs get cheap again. You're suggesting this is different.
That's a cyclical issue. What we're talking about here is structural. When you talk about commodities like eggs or oil, supply is elastic. You can ramp it up.
You can breed more chicken.
Exactly. Real estate is different. And to understand why, we have to look away from the macroeconomic charts for a second and zoom in on what this actually looks like on the ground. Because when we say supply constraints, it sounds remarkably academic. It sounds like a line item on a spreadsheet.
It sounds like something a central banker says to put you to sleep.
It usually works, but the reality on the ground is messy, it's loud, and it is incredibly frustrating. It's about mud and steel and people not showing up for work.
I have a story that I think illustrates this messiness perfectly. It comes from a site manager in Sydney named Callum. Now, Callum is an old school guy. He spent 30 years watching the skyline change. He's seen booms, he's seen busts. But he told me that lately, the rhythm of building has fundamentally broken.
How? Not just slow, but broken.
Well, he oversees a residential project in the suburbs. And if you walk past it, you'd assume they ran out of money. The skeletons of the apartments are there, the concrete is poured, but they sit silent for weeks at a time. No hammers, no drills, just silence.
And that's the assumption everyone makes. The developer went bust, the project failed.
But that's the kicker. The capital is there, the funding is secured. Callum says they are stuck in a paralyzing web of what he calls institutional rigidities.
That is a polite way of saying red tape.
A very polite way. He calls it permitting purgatory. He told me that getting a standard local council approval takes twice as long today as it did a decade ago. Twice as long. Every step requires a new consultant, a new report, a new certification. It's not just build the wall, it's Prove the wall meets the new vibration standard, the new acoustic standard, and the new eco-compliance standard.
Which all sound like good things on paper. I mean, we want better buildings.
They are good things. We want safe, quiet, green buildings. But Callum's point is that the process of proving it has become a full-time job. His project managers spend more time on paperwork than on, managing the project.
So the administrative friction has just exploded.
The real nightmare, the one that actually keeps him up at night, is the labor market.
Finding hands to do the work.
Finding skilled hands. Callum used this phrase that stuck with me. He said, finding a certified electrician right now feels like winning the lottery.
I've heard that from developers across the region. It's same in Seoul, same in Singapore. The skilled trades are just, they're gone.
He spends days just calling subcontractors who don't pick up the phone. And because of these bottlenecks, the waiting for permits, the waiting for sparkies, the cost of just existing as a construction site skyrockets.
The burn rate.
Exactly. The insurance, the equipment rentals, the scaffolding, you're paying rent on that scaffolding every single day it sits there, whether you're building or not.
That's the invisible cost that the public never sees. They just see the final price tag and assume it's pure profit.
Right. And Callum's point was that this sets a hard floor for the eventual price of the units. Even if the global economy cooled tomorrow, he literally cannot drop the price. The cost of overcoming the red tape and the delays has already been baked into the brick and mortar.
That hard floor concept is critical.
Yeah.
And Callum's story is not anecdotal. It is symptomatic of a region-wide sclerosis. What he's describing is a phenomenon that economists are struggling to model because it doesn't fit the standard supply and demand curve.
Because usually, if demand drops, prices drop. Callum is saying he can't drop the price or he goes bankrupt.
He creates a loss. And builders don't build to create losses. They just stop building.
Which is the stagnant horizon you saw in Tokyo.
If the market price falls below the construction cost floor, supply goes to zero. It just stops. It's not a gentle slope down. It's a cliff edge.
So let's peel this back a layer. We have the permitting purgatory, that's bureaucracy. But what about the materials? You mentioned steel and timber earlier. We aren't in 2021 anymore. Didn't supply chains normalize after COVID?
They normalize in terms of delivery times. Ships are moving again. You can get a container from Shanghai to Sydney on schedule now.
Yeah.
But the baseline price of the inputs has reset. We have data showing that the Russia-Ukraine war, which might feel very distant to a builder in Sydney or Tokyo, exacerbated global steel and timber prices to a degree that we haven't fully recovered from.
How much of an impact are we talking about? Was it just a blip?
It wasn't a blip. New construction starts globally slowed by nearly 22% between 2020 and 2022.
22%. That's a fifth of all new buildings that just didn't happen.
That is a massive chunk of future supply simply vanishing because the math didn't work. Energy prices drive the cost of producing concrete and steel. Smelting steel is incredibly energy intensive. When energy prices spiked due to the war, the cost of the skeleton of the building spiked.
And that cost doesn't just evaporate when the war news fades from the front page.
No, that new, higher price becomes the new normal. The suppliers aren't in a hurry to bring it back down. And then you layer on the labor nuance you mentioned with Callum. You said finding an electrician is like winning the lottery. We need to be specific about why that is, particularly in this region. This isn't just people don't want to work.
Right. In the U.S., you hear about the Great Resignation. Is that happening in Asia?
It's more structural than that. It's demographic. In Japan, specifically, the construction workforce is aging rapidly. The average age of a site worker is climbing every year, and they are retiring in droves.
So who's replacing them?
Right. Now, in a different political environment, you would fill that gap with immigration.
You'd bring in workers from Southeast Asia or South Asia, like you see in the Middle East.
But Japan has historically strict immigration policies. They are loosening them slightly, but nowhere near the rate of replacement. So you have a shrinking pool of workers. Basic economics. When supply of labor goes down, the price of labor goes up. This has turned Japan into one of the most expensive construction markets on the planet.
So you have high material costs meeting a desperate shortage of human hands.
In a regulatory environment that extends the timeline. It is the trifecta of cost inflation.
And that's where it gets really interesting or frustrating depending on where you sit, because you see governments trying to fix this housing crisis. Right? They see the prices skyrocketing in Seoul or Sydney, and they say, okay, we need to cool this down.
They pull the standard levers.
They restrict mortgages, they raise interest rates, they try to kill the demand.
It's the classic policy paradox. Governments are obsessively pulling demand-side levers to fix a supply-side problem.
It's like trying to put out a fire by arguing with the smoke.
Take South Korea. They have been incredibly aggressive. They curbed mortgage lending significantly to try and stop flat prices from rising. But think back to Callum. If the cost of the steel, the concrete, and the labor required to build the apartment has gone up by 40%.
No amount of mortgage curbing is going to make him lower the price below his cost.
He simply won't build. He can't build, so the supply constraint gets worse. And this brings us back to that double-edged sword you mentioned in the intro. This is the part that is uncomfortable to talk about because there are winners in this scenario.
The gold mine for landlords.
If you are an existing landlord, let's say you are a large institutional investor owning a block of apartments in Tokyo or an office tower in Sydney, this paralysis is actually fantastic news for you.
Because if Callum can't build the new apartments down the street, my old apartments are the only game in town.
Scarcity is the ultimate driver of value. If no new supply is coming online, your existing asset becomes gold. Rents go up because tenants have no alternative. What choice do they have?
So for the investor, it's a boom time, but for the buyer?
For that young woman in Minato City, it is a disaster. She is trapped. We are seeing advertised stock in Australia hovering at 25% below the 5-year average. In Tokyo, new flat supply is at a 50-year low.
A 50-year low in a city that's constantly rebuilding itself.
Unbelievable. And this creates that structural floor for inflation. Monetary policy raising or lowering interest rates cannot easily fix a problem caused by a lack of welders and a shortage of timber. We're dealing with the physical limitations of the built environment, not just numbers on a screen.
So we have this environment where it is incredibly difficult and expensive to build anything new. You'd think that might scare investors away. You'd think they'd look at that permitting purgatory Callum is dealing with and say, no thanks, I'll put my money elsewhere.
Well, it's the opposite.
In fact, we are seeing massive amounts of capital flowing into specific parts of this market. If it's so expensive and hard to build, why are investors still interested? We need to look at where the money is coming from and why it is moving the way it is.
We have to follow the flows. And the flows are telling a geopolitical story.
I was reading a series of reports recently about the quiet, high-stakes shifts in Tokyo's luxury real estate, and it brought to mind a portfolio analyst named Akihiro. Now, Akihiro is the guy staring at the screens all day, tracking the millions moving across borders. For years, his firm looked at the mainland China for growth. That was the engine. That's where you went for big returns. But lately, the geopolitical risk premium has changed the math entirely.
The risk premium is the extra return you need to justify taking a gamble. A higher risk demands a higher reward.
And the gamble on China has gotten too expensive for some, or at least the perception of risk has gone up. So try to imagine Akihiro's screen. He sees massive institutional funds money that used to flow into Shanghai or Shenzhen suddenly pivoting. And this isn't a gentle turn. It's an aggressive force pivoting toward the narrow streets of Minato and Chiyoda.
It's a hose being redirected from a huge field into a tiny garden pot.
And this isn't just a casual preference. He called it a mathematical flight to safety. Because Japan offers a safe haven status and Tokyo has such a chronic shortage of new, high-end supply, which we just talked about, this diverted capital is acting like a pressure cooker.
So the supply problem actually makes it more attractive to this kind of capital.
Akihiro watches as bidding wars between global pension funds drive asset prices up by double digits in months. These aren't individuals. These are massive funds from Canada, the US, Europe.
They're effectively importing inflation into Tokyo.
Because the money has nowhere else safe to go. Looking at Akihiro's world, it's easy to feel a sense of unease about how global tension dictates who can afford to live in a local neighborhood. As an observer, I see this as a cold, mathematical reality of the modern era. When the world gets volatile, the few stable corners of the map become incredibly expensive very quickly. While we might feel the unfairness of local residents being outbid by faceless global capital, from a purely analytical standpoint, we're witnessing the literal price of stability in an unstable century.
Akihiro's screen is telling a story that goes beyond just Japan, though. It's telling the story of the denominator effect and the global search for yield in a distorted world.
Okay, denominator effect. That sounds like something from a math nightmare. Why does a pension fund in Canada care about a denominator?
It's actually quite simple, but it drives billions of dollars of decisions. Think of it like a balanced diet. Global pension funds and sovereign wealth funds have strict allocation rules, a recipe they have to follow. They might say, We need 10% of our money in real estate, 40% in stocks, and 50% in bonds.
Oh, okay. That's the recipe. That's their mandate.
Well, over the last few years, the value of bonds and equities dropped significantly in many markets. The stock market had a rough patch. So suddenly, the total value of their portfolio, the denominator and the fraction, shrank.
So if I had $100 and $10 was in real estate, I was at 10%. But if my stocks crash and now my total portfolio is only worth $80, that same $10 in real estate is now, what, 12.5%?
You got it in one. Suddenly, without buying a single new building, you are over-allocated to real estate. You have too much of it, percentage-wise. So technically, the rulebook says you should stop buying real estate. You should essentially go on a diet to rebalance.
The budget for the dinner party is blown, so you stop buying the expensive wine.
But, and this is a huge but, these funds still have a mandate to generate returns. They can't just put the money under a mattress. They have pensioners to pay. So they need a place that feels secure and offers a return. And this is where Japan becomes a unique anomaly. It is one of the only major markets where you have positive carry.
We're hitting all the jargon today. Let's unpack positive carry. It sounds good. Everyone wants to carry something positive.
It is good if you're an investor. It is the difference between the cost of borrowing money and the income you make from the asset you buy with it. Let's imagine you want to buy an office building in New York today. You go to the bank, and because interest rates shot up, they charge you, say, 6 or 7% interest on the loan.
Okay, so I'm paying 7% to the bank. That's my cost of capital.
Right. But the building, because rents are struggling in many U.S. cities, might only yield a 4 or 5% return from the tenant's rent.
So I'm paying 7 to make 5. I'm losing money every time I wake up in the morning.
That is negative carry. You are bleeding cash. You're betting that the building's value will go up enough to cover that loss, which is a big gamble right now.
Okay, so that's the rest of the world.
But now, fly that plane to Tokyo. In Japan, the central bank has kept interest rates at rock bottom around 80 basis points, or 0.8%.
That is practically free money compared to the US or Europe.
So global investors can borrow money incredibly cheaply in yen, buy a building in Tokyo that yields 3 or 4%, and pocket the difference. The spread is positive. It is almost free money if you can navigate the market. That is why Akihiro sees that flood of capital. It is the only place the math works so clearly.
And then you add the currency factor on top of that. The yen has been historically weak. So if I'm a US dollar buyer, Tokyo is essentially on a massive discount sale.
You are buying high-quality assets at a currency discount with cheap debt in a stable legal environment. It is the trifecta. For a global fund manager, it's an irresistible proposition.
But we also need to touch on the China context you mentioned in Akihiro's story. We have to be careful here because the narrative in the media is often very polarizing. The headlines are usually about exodus or abandonment, but when we look at the actual behavior of multinational corporations, that's not really true, is it?
It's too simplistic. It's a headline that ignores the complexity on the ground. China's industrial base is vast, sophisticated, and incredibly hard to replace. You can't just move a factory that employs 10,000 skilled engineers to Vietnam overnight. The infrastructure and the talent pool in China are unique, so companies aren't just packing up and leaving.
So it's not a divorce.
No, it's an open relationship. We call it the China Plus One strategy.
Meaning I keep my main operation in China, but my new growth goes somewhere else. My next factory, my next investment goes somewhere else to spread the risk.
Investors and corporations are diversifying. They are hedging their bets. They are directing new growth capital elsewhere to ensure supply chain resilience. And where does that capital land?
If it's manufacturing, maybe Vietnam or India.
Correct. Those are the beneficiaries of the industrial shift.
Yeah.
But for the safe, stable capital investment, the office towers, the logistics hubs, the places to park large amounts of cash, it lands in Japan and Australia. This is creating a bifurcation of capital. We're seeing domestic Asian capital investors from Singapore or Hong Kong still investing regionally. But the big global Western funds are retreating to their home markets or these specific safe havens.
It's a concentration of force.
It acts like a fire hose pointed at a teacup. The overflow is inevitable, and that overflow manifests as asset price inflation. So when the man in Minato City complains about foreigners, he's not wrong about what he's seeing. He's just misdiagnosing the cause. He's seeing the splash from that fire hose.
So we've got the construction side frozen by costs, that's Callum. And we have the investment side boiling over with global capital seeking safety, that's Akihiro. That explains the prices. But I want to look at the skyline again. We know new stuff is hard to build, but cities like Tokyo, Seoul, and Sydney are full of existing office towers, miles of them. If demand is high and new supply is low, are all these buildings gold mines?
No. And this is where the story gets really textured. This is probably the biggest shift in commercial real estate in a generation. Not all square footage is created equal. We are seeing a massive split, a bifurcation between grade A buildings and what the industry is starting to call zombie buildings.
Zombie buildings. Is this a Walking Dead situation for real estate?
It is for the owners. Hybrid work is real. It hasn't emptied offices in Asia as much as it has in the US or Europe, but it has changed why we go to the office. Companies are shrinking their total footprint. They need less space.
Okay, so they need fewer square meters.
But the space they do keep, it has to be spectacular. It has to earn the commute.
Right. If I'm going to drag my employees in on a Tuesday, I can't put them in a beige cubicle farm from 1995 with flickering fluorescent lights and bad coffee.
Exactly. They want high-tech, amenities, good air filtration, natural light, and critically, they need ESG compliance.
ESG, environmental, social, and governance. Why is that so important for a lease?
Big multinational corporations have carbon reduction targets that are public and binding. Their shareholders demand it. They literally cannot sign a lease for a building that isn't energy efficient. Their own bylaws forbid it.
So they're physically unable to rent an old, inefficient building, even if it's cheaper.
Correct. So we have a flight to quality. The shiny new green buildings, the grade A stock, are full, vacancy is low, rents are high. And the grade B and C buildings, the older stuff from the 80s and 90s, they're emptying out. They're becoming obsolete.
And this creates a weird standoff, right? Because if I own one of those old buildings, I don't want to admit it's worthless. I have a loan on it based on its old value.
This is the problem freezing the market. We call it extend and pretend. The owners of these zombie buildings are looking at their spreadsheets, and they see that if they try to sell now, they might have to take a 20 or 30% haircut on the value. They'd have to book a massive loss. So they don't sell.
They just hold on and hope for a miracle.
They refinance, they wait, they hope interest rates drop and save them. They're kicking the can down the road.
But the road is running out. Yeah.
This has frozen the transaction market. Volumes have plummeted because there is a massive bid-ask spread. Buyers say, your building is a dinosaur, I'll pay you 70 cents on the dollar. It's like, I want 100 cents. And until that gap closes, we have this zombie paralysis.
So we have a shortage of new buildings because of Callan's problems, and we have a surplus of useless old buildings because of this zombie problem.
A tale of two cities within the same city.
The obvious solution, at least to a layperson like me, seems to be, why not just turn the old offices into apartments? We need housing. We have empty towers. Just swap the desks for beds, right?
It is the most common question I get. Why can't we just convert them? And it makes perfect sense on the surface.
But of course, nothing is ever that simple. I recently saw an interview with a specialized developer in Seoul named Min-jin, who spends his days inside these zombie buildings, those grade B office towers from the 90s that are too old to be prestigious but too expensive to tear down. Min-jin's job is a complex game of regulatory arbitrage.
Arbitrage usually means taking advantage of a price difference.
Yeah.
But here it means taking advantage of a rule difference. He's a rule hacker.
He takes these structurally obsolete shells in the heart of the CBD and maneuvers through a labyrinth of zoning laws to convert them into high-tech, specialized assets. He's not just painting the walls, he's turning them into boutique biotech labs or luxury co-living spaces for the city's tech elite.
So he's not just making apartments, he's finding a niche use that fits the building's weird shape.
It's a high-wire act. One wrong move with a fire safety code or a floor area ratio calculation, and the financial viability of the entire project collapses. But when he succeeds, he's not just making a profit, he's surgically inserting new supply into a city that has run out of dirt to build on.
Min-jin is effectively playing 4D chess with city planning.
Reflecting on Min-jin's work, there's a certain grim brilliance to it. We often talk about the supply crisis as a lack of empty land, but as Min-jin shows, the real frontier is the recoding of what we already have. It's a pragmatic solution to an existential urban problem.
It is pragmatic, but you are right to highlight how difficult it is. The just convert it narrative overlooks the physical reality. Think about the shape of a typical office tower. The floor plate, the footprint of the building is usually a big, deep square. You have elevators in the middle and desks spreading out to the windows.
Right, massive open spaces designed for cubicles.
But for an apartment, you need natural light and ventilation for every habitable room. A bedroom, a living room. You can't have a bedroom in the middle of the building with no window. So if you take a deep office building and chop it up into apartments, you end up with a lot of dead space in the middle that is unlivable.
You end up with the bowling alleys instead of bedrooms. Long, dark corridors.
And then there is the plumbing. This is the killer. Offices have one central bathroom core pro-way. Everyone walks down the hall to use it. Apartments need a bathroom and a kitchen in every single unit.
So you have to drill through concrete. That sounds expensive.
You have to drill through 10 inches of reinforced concrete slab 50 times per floor to run new sewage lines, new water lines. It is astronomically expensive. There was a study done by SBR regarding San Francisco, but the math applies almost everywhere, including Seoul and Tokyo. It showed that for most office buildings, the cost of buying the building plus the cost of conversion is actually higher than the market value of the finished apartments.
It creates a feasibility gap. You lose money by doing it. So it's a non-starter for a rational developer.
It simply doesn't pencil out financially without help. So Min-jin would go broke if he just tried to do this on his own in a standard market.
That is where the regulatory arbitrage comes in. He needs the rules to change the math.
Look at Singapore. They're very pragmatic. They saw this problem coming. They introduced the CBD incentive scheme. Basically, the government tells developers, if you take this old office building over 20 years old and convert it to residential or hotel use, we will give you 25 to 30% more gross floor area.
So they let you build bigger or denser than the original zoning allowed? That's the sweetener. That's the value that makes the project work.
That is the subsidy that closes the feasibility gap. Without that government intervention, without that recoding you mentioned, Min-jin's project fails. It's a great example of how policy has to align with physics to solve the problem.
There is also another strategy here, isn't there? If you can't convert, you upgrade. You mentioned brown to green?
Yes. This is becoming the dominant strategy. If you can't convert it to apartments, you upgrade it. Investors are looking for these dirty, inefficient brown buildings. They buy them cheap if they can get the seller to agree, and then invest heavily to retrofit them to green standards. New HVAC, new windows, smart energy systems, solar panels. So they're fixing the ESG problem. Exactly. Then they lease them out as grade A office space at a premium. It is the biggest value-add strategy in Asia-Pacific right now because, again, you can't build new easily. You have to polish the old. It's recycling on a monumental scale. Instead of recycling a soda can, you're recycling a skyscraper, a very, very expensive skyscraper.
So let's zoom out a bit. We've talked about the struggle to build, Callum, the flood of money, Akihiro, and the attempt to reuse what we have, Min-jin. For a long time, real estate investing seemed easy. You buy a building, interest rates go down, the building gets more valuable. You look like a genius just for showing up. But that era, the era of cheap money, is over, or at least suspended. So if you are an investor today, how do you actually make money? If you can't just count on the rising tide lifting all boats, what do?
You have to actually work for it. It's a fundamental shift in the mindset. We are moving from an era of yield compression, where falling rates did the heavy lifting for you, to an era of income growth.
Yield compression basically means the asset price goes up because the bank rate goes down, making your property's return look better by comparison.
Correct. Your building didn't get better, the world just got cheaper around it. But now, with rates higher and stickier, you only make money if you can actually raise the rent. That is income growth. You have to actively manage the asset to make it more desirable so people will pay more to be there.
And this connects back to our first point about supply constraints. If Callum can't build new supply, landlords have pricing power. They can raise rents because tenants have nowhere else to go.
That is the cynical but accurate truth. But the smart money is also pivoting to different types of real estate. We are seeing a shift away from the traditional office and retail portfolio toward alternative sectors, things that are less tied to the business cycle.
But what's the new hot thing?
First, multifamily or build to rent. This has been huge in Japan for a long time, as we discussed with the intro story. People always need a place to live. It is a needs-based asset. Even if the economy slows, you probably won't move out of your apartment.
Right, you might cut back on eating out, you might cancel Netflix, but you keep the roof over your head.
So the income is very stable. We are seeing this sector emerge in Australia now too, although the tax structures and construction costs make it a tougher business case. But the demand is definitely there.
It's defensive. Also, I keep hearing about AI. Does that impact real estate?
Data centers. Every time you use ChatGPT or stream a video or save a photo to the cloud, that data lives in a physical building. The demand for data centers is exploding. It's almost vertical. But here is the bottleneck again. Power.
Power. Not land, not labor, but electricity.
These facilities consume the electricity of a small city. Finding locations with access to that much power grid capacity is incredibly hard. You can build the shell, but if the utility company says, wait 5 years for a connection, you're dead. So if you own a data center site with a secured power connection, you're sitting on a gold mine.
It's the digital version of land scarcity. Instead of location, 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 it's power, power, power.
And then there's logistics, warehouses. It's still strong because of e-commerce, but we are seeing pockets of oversupply. The focus now is on high-tech automated facilities, not just a tin shed, but a robotic fulfillment center, where the floor is perfectly flat so the robots don't trip. The specifications are getting much higher.
And surprisingly, retail is showing resilience in Asia. I feel like in the US, the headline is always the death of the mall.
That is a critical lesson. Real estate is hyper-local. A headline about a crash in San Francisco office space doesn't necessarily apply to a grade A tower in Marunouchi, Tokyo. In Asia, malls are social hubs. People go there for the air conditioning, the food, the social interaction. It's a destination.
It's not just a place to buy things.
No. Plus, revenge spending from tourism is keeping luxury retail strong in places like Tokyo and Seoul. The tourists are back, and they are spending.
So you can't just read a global headline and assume it applies to your street.
Never. You have to look at the local supply and demand dynamics, the local culture, the local regulations. It's all about the ground truth.
So bringing this all together, we started with the woman in Minato City, staring at that price tag in defeat. We've traced the invisible lines that led her to that moment. We traveled to a construction site in Sydney with Callum, seeing how bureaucracy and labor shortages pour the concrete floor of inflation. We looked at Akihiro's screens in Tokyo, watching global anxiety transform into a flood of capital that bids up safe assets. And we walked through a zombie tower in Seoul with Minjun, watching the desperate, high-stakes attempt to hack the regulations and create something livable out of the obsolete.
It creates a complex picture. We are witnessing that double-edged sword in action. We are entering a period where real estate is no longer a passive bet on falling interest rates. It's not easy money anymore. It has become an active, difficult industry of navigating bureaucracy, navigating geopolitics, and navigating the physical limitations of concrete and steel.
The safety of real estate is now dependent on the ability to solve these complex puzzles. It's not enough to just own anymore. You have to create value against the friction of the world.
But
for the woman in Minato City, the puzzle remains unsolved, trapped between the floor of construction costs and the ceiling of global demand. And as we look at the skyline, stagnant yet expensive, we have to realize that this isn't just a market cycle. It's a new reality where the friction of the physical world is finally charging its price.
And that price is being paid by everyone, from the pension fund manager to the renter on the street. It affects us all.
Thanks for taking this deep dive with us.